Hi, I'm James Robinson. I manage money for a living, and this is my stock pick of the week. So this is the fourth and final video on the company Alphabet, which many of you will still know as Google. The symbol is GOOG or GOOGL. It doesn't really matter which one you buy whichever one's cheaper. I usually do a video on dividends. However, Google doesn't pay any dividends, or Alphabet doesn't pay any dividends, and so there's nothing to talk about on that front. That brings me to the final video, which is wealth creation. So what I look at in wealth creation is what kind of job does the management of this company do in creating wealth for the shareholders? We've looked at the operations and how the company manages providing goods and service to customers. We looked at balance sheet, which is the company's risk structure. But now we're looking at what happens to all that money when it comes in. How does it enrich the shareholders? And there are 5 basic tools that management can exercise to create wealth for the shareholders. The first thing is directly pay us cash. Those are called dividends. This company doesn't do that. The next thing is buy back stock. That creates benefit from the shareholders because every year you'll own a slightly larger percentage of the company, even though you've invested no additional money. The company can pay down debt. The company can accrete cash, which it simply can hold and either invest or use that money to create a buffer of safety in case bad times come. And finally, the company can reinvest in the operations of the business. And those are really the tools that they have. And so what we're going to do today is look at how this company performs in those categories. So the first thing that we want to do whenever we look at this, I always start with shares outstanding. Shares outstanding is a beneficial way that the company can reimburse shareholders or provide profits to shareholders that is non-taxable. Long story short, if a company buys back 10% of the shares, that means that your percentage of the company's ownership is increased by 10%. It also means that the same amount of earnings are being spread over 10% less shares, so you'd expect to see a 10% increase in earnings per share. Those two things together make the buying back of stock beneficial to the shareholders, and so that's where I start this look. You can see here that this company has been buying back shares since 2017. Not a ton, but they've been buying back some. The problem is over the last 10 years, the company actually has been a net seller of stock. Now, this company isn't selling stock to fund its operations. This company is selling stock basically as a way to either compensate their employees without having to pay them cash, which is very popular in Silicon Valley, or oftentimes they're giving shares away when they do these little tiny bolt-on acquisitions. And I say I say tiny in the context of the size of this company, which is a $1.2 trillion company. So if they buy some software company in Silicon Valley for $2 billion, oftentimes they'll buy that with stock. And that's why you'll see that the stock here is, the amount of shares outstanding has gone up. I don't like companies where the shares, where I'm getting diluted. It's a very big red flag for me. Again, the economics of this company, the thing to think about here is that you can't be dogmatic. When you see something you don't like, you have to try and understand why you don't like it. And is there an exception that this company generates that allows you to overlook that? And again, what we've seen with this company is, and I'll show this in the next slide, while the shares outstanding are expanding, they're expanding very, very slowly, especially in relation to the earnings increase. So let's talk about the next slide. So here you can see if you owned 10% of Google stock at the end of 2011, you'd have owned 1.3 billion shares. Today, through stock repurchases, your 1.3 billion shares would mean your ownership in the company has decreased from 10% to 9.8%. That's a 2% decrease over the 10-year period. So you own 2% less of the company than you would have 10 years ago. And that obviously would be a red flag. But your share of the company's earnings would have gone from 937 million to 7.45 billion over the last 10 years. So your 10% stake in the company is earning you about 7 times as much money. So what I'm focusing on here is the donut, not the whole. The whole is, yes, we own slightly less stock because we were diluted, but hardly at all. And the company's earning capabilities have increased so dramatically that, again, I'm willing to overlook it. Looked at another way, your earnings per share would have gone from 75 cents per share to $5.70 per share. That's an increase of 665%. So we've had a 665% increase in the income from our stocks. And we have that despite the fact that we have a decrease of 2% in the value of this, in our equity in the company. The next thing that I look at in terms of wealth creation with a company is how much shareholder equity we have. I like to see shareholders' equity going up over time. Obviously, you can see with this company, it's gone up very dramatically. Just 10 years ago, it was at about $75 billion in shareholder equity. and now it's tripled to $225 billion in shareholder equity. It used to be, as a Graham investor, you were looking for shareholder equity per share that was greater than the share price you were paying. You're actually looking for cash greater than the share price you're paying for a stock. That's not really that easy to find anymore, and I actually don't think it's that important to find anymore. There's just too many people out there, looking for companies like that relative to the number of companies that exist. Also, we're not looking for companies that we can buy cheap. We're looking for good companies or great companies we can buy at very fair prices. So when I see shareholder equity going up, especially going up this dramatically over time, that's a good sign that the company isn't squandering the money that they're keeping, that they are actually creating value for the shareholders. This is one of the most important slides that I look at for a company, and that's return on assets. So I say every time that it obviously takes money to make money in business. The question is, how much money does it take to make money? We would like it to be the situation that a little bit of money makes a lot of money versus a lot of money in terms of assets making a little bit of money in terms of income. So here you can see this company's return on assets is spectacular. The red line represents the top 10% of all companies. This company has been maintaining that, being clearly in the top 10% of companies, with the exception of 1 year in 2016. Basically every single year. In the last year, it's gone up pretty dramatically. So we love this company. We love companies that do fantastic return on assets. That means that every dollar they retain in the company should equal greater and greater profits for us, the shareholders, versus some companies when they retain earnings, they're able to generate no additional income from those retained earnings. So this is a really spectacular sign when you look at this kind of return on assets, and then you look at what we showed earlier, which is the massive increase in earnings over time. This is the reason I overlook the fact that the company pays no dividends and that the company hasn't even bought back any stock. They're accumulating a bunch of cash, but despite the fact that they're accumulating all that cash, they're still paying fantastic returns on assets. This next slide is return on shareholders' equity. There are a lot of people who believe shareholders' equity return on equity is more important than return on assets. I completely disagree with that. So the difference between the two, return on assets, you take all of the assets the company has, you take the profits that the company has, you divide the profits by the assets, and that gives you the return on assets. And so that basically is a measure of how efficiently the company is using the assets that they're keeping on their balance sheet. Return on shareholders' equity is the exact same thing, except that rather than looking at assets, they take all of the assets, they subtract out all of the debt, and they're left with equity. The fact of the matter is it's easy to earn much higher returns on equity than it is a return on assets because you're leveraging up your equity with a bunch of debt. The problem is we're also then rewarding companies for taking on debt, and I don't like to do that. I like to punish companies who take on debt because I think debt is a bad sign. If a company is really well run, it shouldn't need debt. If it's a great company, it should be able to fund its own operations. So having said all that, this company has traditionally been in the top 25% of companies. That's really good. In fact, last year it was in the top 10% of companies, which is spectacular considering how little debt it has. So it's competing on this slide against companies that have a tremendous amount of leverage and thus are able to get these fantastic returns on equity, and it's doing it without all the debt. So that's just another good sign that this company is in a fantastic position. So one of the levers that the company can pull is to retain earnings. And what that means is that they take the profits that they make and they keep some of those profits in the operation, and they use that money hopefully for corporate benefit, whether to buy other companies, invest in continuing operations, whatever it might be. And what you can see here that's really great is that even though the profits have gone up very dramatically, over the last 10 or 15 years, the retained earnings have been very narrow. So they're able to earn higher and higher profits on smaller and smaller percentages of retained earnings. That's a fantastic sign. We really like that. That's one of the reasons that they're able to maintain these really high return on assets, because they're not keeping a lot of additional assets relative to their additional profits. So this is a very good sign for us as investors. This slide is a little bit, it needs some explanation. So what I want to figure out is what kind of return are we getting on retained earnings? What I say to myself is, if a company's retaining all this money, how do I figure out if that money is being used efficiently? Now, if I was a forensic accountant, I could go back in and see where every dollar went and get to the bottom of it. I don't have that kind of training. I don't have that kind of time, and I don't have that kind of access to the decision-making the company's making. So this is kind of a cheat sheet for me. What I do is I say, how much money did the company retain in the last 10 years? And so I say that's retained earnings that should have been invested towards the good of the company. And then I say, how much did earnings increase over that same 10-year period of time? And that basically is a shorthand for saying, okay, that money that invested created this additional amount of earnings. Now, I know that that's not completely accurate. I know that there may not be a direct correlation between the money that they retained and what they invested that money in creating profits. But in the aggregate, one would think that over time there would be a correlation, which is why I use this really long 10-year time frame. So it's not exact, but it does give me a sense that even if they're misusing every penny, they're probably not. And likely, it's hard to misuse every penny and still generate profits over time. So my goal is that a company should get a 10% return on retained earnings. You can see this company is far, far north of that, closing in on 20% on retained earnings. So the little bit of money this company retains, and it's a smaller amount every year relative to profits, seem to be doing a good job of generating profits for the shareholders. And so I really like this. And so this is a good sign for this company. Another thing that a company can do with its assets is, with its profits, is to hoard cash. I think this company hoards far too much cash. I'd love it if they would pay us a dividend or buy back shares at an accelerated rate. They don't seem to want to do that. But having said that, as they're hoarding all this cash, that becomes additional assets on the balance sheet, and they're still getting these fantastic returns on assets. They're still getting these fantastic returns on equity, and they're still getting fantastic returns on retained earnings. And so I just give them a pass. I just say, look, I don't really like it, but you guys probably know more about what you're doing than I do. And so we'll keep riding it while it looks this good. So this is a slide that's really sexy. What we're doing here is we're saying, if we look at each of the categories that a company can utilize, so buying back stock, they're returning money to the shareholders that way, paying dividends, returning money to the shareholders that way, increasing in cash, that's a benefit to the shareholders, and paying down in debt. If we look at all of these things and we add them all up, the orange line shows you the sum total of those changes over the last 5 years. And you can see that it's just spectacular. This company has generated wealth for the shareholders over the last 5 years of $100 billion. I mean, that's spectacular. So this chart gives me sort of the summation of all things we've talked about. So in summary, I would tell you that I don't love what the management does to enrich the shareholders. I don't love that they're not paying a dividend. I don't love that they're not buying back stock. I don't love that they're keeping too much cash. I don't really love that they are taking on debt that I don't think they really need. Although I recognize borrowing money at 3%, why wouldn't you? I think that will slow down. When you add all that up, the fact of the matter is it's still generating wealth for the shareholders. It's just directing indirect wealth. And the generation of indirect wealth typically manifests as stock increases, and that's okay too. So this company's doing it in a way, they're such a good company, they can get away with doing things that I don't like, and I still think they're a fantastic company. So that's my summation of Alphabet. We're buying it at 18 times earnings, which is very, very cheap. The company is very, very well run. It has very little debt. The wealth creation numbers are there. They're just there sort of circuitously, not in a way we traditionally like. And so I can tell you without hesitation that you should be buying Alphabet. Thank you very much for your time.